So our topic this morning is managing cash for growth. And in my mind, this is among the very most important topics for angel investors, because almost every entrepreneur that I've ever worked with thinks what he has to do is make his business profitable. And that's wrong. Because you can be profitable and you can run out of cash. So profits is the wrong target. I'm on a board right now where we have a fast-growing business that turned profitable in November. And the entrepreneur just can't quite get his head around that I have to manage for cash, not for profit. And we keep running out of cash and having to slow down the growth rate because we're not managing to the working capital needs of the business. So it's a real challenge. And of course, when a business really runs out of cash, if there isn't somebody standing by in the wings to write another check, then it's very bad news, right? So we're going to do this session by using the Butler Lumber case. Now, some of you have read the case, I think. If you've read the case fully, can I see a show of hands? Okay, so some have not. So I think it's very short. We should take some time to read it. So I'm going to split the room into two halves. You guys at these two tables, you are the banker. All right? So your job is to decide whether or not you're going to give Mr. Butler the new, larger credit line he wants. And you guys are Mr. Butler as we do this, right? So I think the thing to do to start off is to read the case. And once you've read the case, then we'll start diving into it, and we'll figure out what we're going to do. Okay? So could we take 10 minutes for those who haven't read it to read it? For those who have, maybe you could start looking carefully at the numbers and get a sense for what's going on in the business. First of all, why does Mr. Butler need more money?
Fund expansion.
To fund expansion.
Fund growth.
Okay.
He's up against the wall. He's not able to finance with current credit limits. Requirement for capital to grow the business.
So is it a profitable business?
Yes.
Yeah? And it's growing?
Yes.
Yeah?
Growing by sales.
Its sales are growing?
But not profit.
Are profits growing?
No, profits are actually almost coming to zero. They're approaching
Well, they're small, but are they growing?
They were growing till 1990. Giving more than liberal credit. Profitability is not growing. Profit is growing.
Profit is growing, right?
Should grow. This is trended.
Yeah, we have profit data, right? It's gone from 31 to 34 to 44. That looks like it's growing, right? So why does a profitable growing business need more money? Don't profitable growing businesses create the money they need?
If they grow outside of their, he's growing outside of his.
No, so money can either go to working capital, which tends to be 90% of problems any growing company faces. Right? So your debtors and credit cycles don't match. You have to give out more credit to have more sales. So your clients get bigger, they demand more credit. And then your capital gets sucked into working capital. Your free cash flow gets sucked into working capital and you need more working capital.
Hence, we don't have the cash flow statement here. With the cash flow statement, the free cash flow would be negative.
Inventories and receivables.
So let's make one, shall we? So I want to give you some simple tools. It looks like some of you probably are pretty comfortable doing these kind of things already, but perhaps I'll give you these pages, so if you want to make some notes on them, you're welcome to do so. Okay, so here's the page I've put up there. So these are, for those who aren't normally used to looking in detail at financial statements, these are some simple tools that you can all do with a cocktail napkin and a calculator. You don't need Excel. You don't need a CFO to do what I'm going to ask you to do. So the first thing I want to know, since he's running out of money, I want to know, well, where's the cash going? Is that a reasonable question to ask? Yeah?
Accounts receivable, obviously,
So in order to find that answer out, we can create a little statement, a cash flow statement, that shows the sources of funds and the uses of funds, right? Okay? So this is a really simple thing to do. Here's what I did here. I took the change in the balance sheet from 1988 till 1990. So I'm taking these two columns, and I simply subtracted one from the other on every line. And I put that change number in this column. So for example, 270 subtracting 348, that gives me 78, right? Or 64 subtracting 50 gives me 14. And for the moment, I don't worry about whether it's plus or minus. I just figure out the difference and I put it in a column. And then I ask myself, okay, once that's done, I have to take each of these numbers and move it into one of these two columns. So does that number mean it was a source of cash to the operation of the business, that change in the balance sheet number, or was it a use of cash to the business? And that's mostly easy to do on a common sense kind of basis. So let's start at the bottom. Net worth went from 270 to 348, so it increased by 78,000. Is that a source or a use of cash? That's easy, right? It's a source. Okay? We go up to the next line. Long-term debt went from 64 to 50, so we paid our debt down. Is that a source or a use? It's a use, so we put it in the use column. Accrued expenses. That's probably things like payroll that we owe people but haven't paid them yet. Went from 24 to 39. What is it? It's a source, because effectively our people, if we haven't paid them, are loaning us that money, right? Until we pay them. Accounts payable have gone from 124 to 256. So our suppliers are letting us use their money. Another source, right? Next one, Mr. Stark. His note went from 105 down to 0. We paid him off. That is a use of money, right? So this is really very simple to do, right? It's intuitive. The only one that's a little tricky is when you get up to cash. We'll do the rest of them though. So 233 here, notes payable to the bank went from 0 owed to the bank to 233 we now owe to the bank. Okay, so that's a big source of cash. Thank you, Mr. Banker. Then the 31 change in property, 126 to 151. Maybe he bought a couple of forklifts or something, right? It's a use of cash. Inventory went up from whatever that number is, 239, is it? He had a 418. Big growth in inventory, used some cash. Accounts receivable went way up from 171 to 146. Used some cash. And then cash went from 58 to 41. Is that a source or a use? Cash went down, right? So somewhat paradoxically, that is a source, because the cash balance went down. That means you used some of that cash to operate the business. But that's the one that's always tricky to know. Whenever you do this, the cash is tricky to know whether it's a source or a use. So a good way to find out is to put it in one column and add up the column and see if it balances. Because there's a name of this statement. It's called a balance sheet, right? So if you put cash in the wrong column and it doesn't balance, put it in the other column until it balances.
But if you have a negative cash, it is a source. And in your
Do you mean it? We don't have negative cash here. We have positive cash. Cash is reducing.
You're going to fund it. You freed it up for putting it into
To put it into the business. That's right.
When you've taken accounts receivable and inventory and that has gone up, that's the use. This is also a current asset. So if it's gone down, it's a source.
What if the cash would have increased from 58 to?
It would have been a use.
It would have been a use. It would go in the other column. Yep.
Because it's an overdraft account?
No, it's not an overdraft account. It's just, it's a cash in hand. Yeah. It's your current account, the cash you have in your bank. Okay?
The use of cash is just to increase your cash balance.
Well, no.
If you have a positive.
Cash went down from 58 to 41,000, and we used it for something, right? Now, VC, we don't actually know whether we used it. VC, we don't know if we used it to pay down this debt or if we used it to buy a forklift, or we don't know exactly which use it was for, but it was part of the overall pattern of using cash. Make sense?
Yeah, I'm still trying to wrap my head around. You are right, it's counterintuitive.
It is counterintuitive, yeah.
It's not really vague, but I think cash actually fits in net worth basically, because basically net worth on the balance sheet is sort of the balancing figure on the liability side, net of all the liabilities and assets.
Mm-hmm.
And cash basically sort of plugs in, because the moment you have cash increase, the net worth will reduce exactly.
If you want to think of it that way, that's fine. Yeah. But at the end of the day, you can, in your business, or some business you are helping, if you're an angel and you're helping an entrepreneur trying to figure out where his cash is going, he's probably being given a balance sheet and a P&L every month and no cash flow statement. That's what I always find. Nobody's preparing cash flow statements. So what you do is you pull out the balance sheet from 2 adjacent months, and you just do this, right? How long will that take you to do?
About 5 minutes.
5 minutes, right? And you put them in the proper columns, make sure it balances at the bottom. If it doesn't balance, move cash to the other columns, figure out which one you got wrong, okay? Until it balances, then you have it right. And say, okay, now we know where the cash is going. So, where is the cash going? Why is Mr. Butler using so much cash? Anush.
I mean, you're going to do the set-offs, right? You're going to set off accounts receivable against accounts payable. You're going to set off notes payable against bank. Your net figure basically comes to you financed inventory 2/3 by the bank and 1/3 by your retained profit.
So there are some big uses of cash here, right? The biggest one is what? Is that a 196 or 146? I can't read it.
146 and 179.
It's a 146 and a 179. So the biggest use of cash is that inventory went up. And why did inventory go up, do you suppose? It's a cyclical business. We're coming into spring. Maybe we had to stock up. Mm-hmm. And also, why else? Sales have gone up. You need more inventory if you're doing more sales, right? So is it reasonable that inventory should go up?
Depends.
You have to trend it.
We got to figure out if it went up the right amount, but it's reasonable that it went up. Is that fair? Okay. So that's the biggest use of cash. What about inventory? Oh, no, we said inventory. What about accounts receivable? They went up too, right?
Their offsets, you managed well because your accounts payable have gone up reflectively almost the same thing. So your net financing for receivables versus payables.
So you're trying to compare this number with that one that I can't reach up there, right?
I don't think that these are two independent things, right? These are vendors versus.
They are independent, but it's worthwhile thinking, can I get one to finance the other? It's a fair question that effectively Anuj is asking, right? If I could get my suppliers to finance my customers, that'd be nice. Yeah. Okay? So, a lot of money is going to receivables and inventory. A little bit of money is going to a small amount of additional property, forklifts, whatever it is he bought. And there's a chunk of money over the 2-year period that went to pay back Mr. Stark, right? Okay.
But you see, you've taken short-term money, in the sense notes payable to the bank, to fund long-term, to pay off Mr. Stark.
If you want to argue that, yes, you can. You can say, well, I wanted to pay off Mr. Stark, so I borrowed from the bank, I got the money from the bank, and I used it to pay Mr. Stark, and I used some more of it for inventory and payables as well, right? Or receivables as well.
The thing is that it is not so much of a business decision. It's his personal decision to kind of put it on business. So he should have leveraged his personal property or personal assets to do that, and it should not be reflecting in the balance sheet. I think
You could argue that, but this is the asset he has, and that's how he was able to do it. And is it reasonable to think he should have wanted to get rid of Mr. Stark and buy the business and own it himself? Yeah.
no, why not?
Yeah. Personal thing that's perfectly reasonable. Cash is this company really burning here? It's a profitable business, but if we look at the uses, what do they add up to? If we add up to the sort of changes in working capital that are independent of the financing sources, that's those top three numbers, right? The 146, 179, and 31. That adds up to 356,000. Change in working capital that's sort of being driven by just operating the business. Forget about whether the banks give it to us. And the sources are 17 and the 15. Right? So the operating cash flow of this business is sort of the net between those. Question, Anuj?
Yeah, I just want to know, would it be fair to try to just, a quick calculation, what I was mentioning, you try to do the offsets as fast as possible to come to a quick conclusion to, as I see it, glaring it seems at least to me, the inventory is where the money is going, and half of it's being financed by retained profit, and half of it's being financed by notes payable. So you're taking a judgment call and saying, okay, half the business's growth is self-financed, the other half is financed by notes payable, and therefore this is sustainable in terms of growth, and that's how much money will suck in for every additional period. That be
That's a reasonable thing to say. Yeah, exactly. Yeah. Okay? So even though this is a profitable business, it's quite clear that it's burning cash, right? There are more uses arising from the operation of the business than there are sources arising from the operation of the business. So a second question we might want to ask is, well, okay, inventories and receivables and things have gone up. Have they gone up by appropriate amounts? Yeah? So to do that, we could look at the cash days of the working capital accounts. So take a look at these pages, and I'll pull them up on the screen. Thank you. There are three key working capital accounts in this particular business, where short-term money varies according to how quickly the business grows and how well it's managed. They are accounts receivable, inventory, and accounts payable, right? So what I want to do is know how many days worth of each of those things I have. So the question you might ask is, John, how did you calculate those days, right? And the way I did it is I went to the profit and loss statement and I looked at the top line sales number in 1990 and I divided it by 365 days. And I said, how much sales am I doing a day? And I did the same thing for the cost of goods sold line and said, how much am I doing in cost of goods per day? And then I take those figures and divide them into the balances. And so if we look at accounts receivable, taking 1988 sales and dividing that into the 171, you get 37 days. Does anybody want to kind of look at that number and make sure that I'm right here? $88 sales divided by 365, then we take that daily rate and divide it into the receivables. Does that work? Okay. Crucially, I got it right? Yeah? Good, I can still do maths. Okay. Now, if we do the same thing in 89, we divide 89 sales by 365 and we get 40 days. And if we do it for 1990 and do the same thing, we get 43 days. And if we want to do the first quarter, we can divide the first quarter's sales by 91 days. Does that make sense? First quarter divided by 91, and we can do it for that data too. So what's happening with the days of accounts receivable? It's going up, right? Okay. Is that good news or is that bad news that it's going up? We're letting our customers pay us more slowly, right? Yeah. How much is that costing us in cash? Suppose that 43 figure here were taken back to 37. If Mr. Butler did a better job managing those receivables. If we could trim that back to 37, would that free up some cash?
A lot.
How much? Well, let's figure out how much cash it would free up. If that figure weren't 43 days, see the 317? I can't quite reach. That figure up there? If that figure became 37 days, what would its value be? We would take 6/43 we would take away from 317, which would get us to, we take 317, multiply it by 6, and divide it by 43. And that number is, what did you say? Somebody ran that. 44. So that accounts for 44,000 of the 146,000 increase we have. Right? Okay, now we can do the same thing with inventory. What's happened with inventory? Went from 71 days to 83 days to 88 days. If we could pull inventory back to that old 7-day level, what would that be? It would be 7 out of 78, which is around 10%, not quite 10%. Well, let's calculate it. We take our daily rate of cost of goods, not our daily rate of sales. You don't use the sales. Use the cost of goods.
Total cost of goods. That's 78.
78? Yeah.
1950 by 365.
Okay. So far my math is still good, right? Yeah? Are we all agreement? The 78 is a good number? Now, if we could trim that 78 back to 71, we'd be taking 7 days out of that, which is about 9%, which ought to be another, what, 37,000? Okay. So if we add up the 44 and the 37, that's 81,000 of our increase between those two categories. is due to the days getting a little out of hand, right? What's the rest of it due to? No, the increase in receivables and inventory. We've accounted for some of the increase. The balance of the increase is caused by what?
It's called the increase in volume of business.
Increase in sales. Holding the days same, but making the sales level bit bigger. Inventory has to be bigger. Okay. Now there's a very important number here on this chart that you see I've written in here. It's the length of the operating cash cycle. That's what OCC stands for. Operating cash cycle. And what I mean by the operating cash cycle is the length of time it takes from the day you receive a piece of lumber until you sell it and then get paid for it. Does that make sense? So every time I buy lumber, I need to use up cash until my customer pays me having bought that lumber, right? So how many days does that run? Well, in this year, it's 37 days. Well, first of all, if I buy the lumber, it stays in my inventory in average how many days? If I buy a piece of lumber, it sits there for 71 days, right? Then somebody buys it, and when do they pay me? 37 more days. So the length of my operating cash cycle is 108 days. Do you follow that? In this year, the length of my cash cycle was 123. It's the sum of those two. And in this year, it was 121, the sum of 43 and 78. Okay? But fortunately, my suppliers are financing a part of that, right? What part are they financing? Well, we go down to notes payable, and we take the 124, and what do we divide that by? What daily rate? Daily rate of cost of goods sold, because that's what we're paying for here, right? Cost of goods. Okay? So we take our daily rate figure for cost of goods, divide it into the payables balances, and we get 37, 49, 48. Right? So that has gone up by a total over the 2-year period. Well, it was on the other sheet. But that is financing a part of this. Okay. So how well is Mr. Butler managing the balance sheet in his business? Would you give him good marks or bad marks? Let's ask Mr. Butler himself. Are you doing a good job at managing your balance sheet or a not good job? What do you think?
You're doing a reasonable job. I wouldn't say it's great because you should be trying to push down your, holding inventory level the same. But
Okay.
It's a growing business. We need to if you're getting more customers in, they will ask for stronger return to trade. I don't understand why he's holding so much inventory. As in, he should be able to push down inventory because it's a commodity that doesn't require a long holding period.
So how would we know if, 80 days or so is a good number for inventory in a business like his?
First thing you do is you do comparables. You see what the rest of the industry is doing. And are you doing as well as them, and is that the industry level or not?
Yeah.
And then that's the benchmark.
So there are two kind of comparisons we can do. We can compare with our own history, which we have here, but you would also want to compare with data from other companies in the same industry. We don't have that data here, so we don't know whether Mr. Butler is better or worse than others in his industry. But it appears that, based on at least his history, you need something like 80 days, 70 or 80 days worth of inventory to have enough to serve the customers, but not so much, that you're tying up too much cash.
So I disagree with Anuj. I think that he is losing sight of his working capital. He's really just going after trying to get volume, and therefore he is going to land up in a mess because his cycle is just increasing. So from 108 days to 123 days, now actually maybe it's seasonal, but it's gone to 139 days. And he's now actually in the real cash crunch.
Mm-hmm. Okay. So you have a little more concern about those numbers than Anuj does. Yeah, fair enough.
I think the other thing is, this business is, primarily a commodity, lumber by nature. It's basically a price that fluctuates very violently. And the issue is that, all he's doing is just adding a bit of value, which really isn't, because all he's doing is molding it into different forms, right? Molding and selling them, right?
He's a trader. He buys and he sells.
So if you see his purchase prices and if you see his sales price, they're absolutely moving in tandem. So it's very clearly evident that he doesn't have any pricing power, so to say, he's basically adding a margin over and above.
So
The problem is that if he grows in business, which is in terms of figure, he's not able to increase his margin, so to say,